All right, this is very exciting. Episode number 1. What is your business worth? We've been busy working away on an app for the last little while here to help entrepreneurs understand what their business is worth. And this is the first episode where I am going to talk through some results that an entrepreneur in our beta group has sent to me because he's looking for some feedback. And so very excited. I think if you're an entrepreneur and you're watching this, you're going to learn a lot. By the end of this, I hope that you have maybe been challenged to think about your business in a different way or to consider things that you may not have considered before. So let's get started. Just going to pull it up here on the screen. Yeah, this is great. Okay, let's get rid of this. So this is, when we talk about business valuation, first of all, every entrepreneur thinks their business is worth more than it actually is. And that makes sense, right? If you're an entrepreneur running a business, you've been sweating it out, you've been straining it out, you've been trying to make sure that all of the activities that you're doing produce a return. You've got people, you've got resources, you're trying to do something worthwhile. And in my experience, I've always found that entrepreneurs don't know what questions to ask in order to make their business better. And it has become apparent to me that using your a business valuation is a great way to do that. And notwithstanding, there are many different ways that you can value a business. In fact, valuing a private corporation is one of the hardest tasks in the world to do because there are so many different opinions about how to do it. But if you don't get distracted by that, and you pick a method, and what we're going to go through today is one method that I believe probably is the most functional one. But whatever your calculation is for coming up with what your business is worth, use that same calculation on a regular basis. In fact, use that calculation today. Like if you Google search how to value my business and you come up with some sort of calculation, use that calculation today, then go back 6 months, use the exact same calculation using the exact same information, and then go back 6 months before that. And between those three, you should get a baseline and go, using the same math, here's how my business is doing from a value perspective. And the reason I say value, the reason I think value is the most important metric to use when, as an entrepreneur, you're trying to build something is because every day your business gets up to use the people and resources that it has to solve a problem in the marketplace. By solving a problem in the marketplace, it generates profit, hopefully, or revenue rather. Then it pays for all its costs, then it has profit, and then that profit, if used properly, is reinvested back into the business and should produce a business that is worth something. So that's kind of the simple logic that any entrepreneur can use. And whether you use the method that I'm going to go through here in the next couple of minutes, or you come up with your own method, just use the same method every time you go to run the calculation, because then it's going to tell you what the value of your business is doing from a trend perspective. And then you can start asking yourself questions like, well, why is the trend going down? Why is the trend going up? What's working? What's not working? And I think business value is one of the simplest metrics to use to begin understanding your business from a different perspective. And so today, as I talk through this, maybe it'll occur to you what that could mean for your business. So I happen to know this individual. In fact, I know everyone in our beta group right now. So I'm hoping to do these episodes on a very regular basis, and hopefully they'll be informative, not just for the entrepreneur who has sent it over to me, but for anyone else who's running a business and is wondering how to build a valuable business, how to be more profitable, and just through some of the things that get discussed, that there's going to be some takeaways. So let's get into it. This particular individual today, based on the math, all this math is being run off a multiple of earnings calculation, which just basically means the business generates profit. After paying all its expenses, there's some money left over. You multiply that by 2 or 3 times, you subtract out the debt that is in excess of the assets, and then you kind of come up with a number. And so that's what's happening here. The calculation isn't as important as what the trend is over time. And so today, this particular individual, their business is worth nothing, like nothing. And we're going to figure out in a minute why that is. But the business could be worth $22,632. What I can already figure out, even if I didn't know who this individual was, but when I see a business like this that is valued at less than six digits, so less than $100,000, that tends to tell me this is a lifestyle business, this is a part-time job, this is a side hustle, this is a part-time gig. It's not, there isn't enough momentum here in order to make, to make this business anything significant without some sort of an investment from the entrepreneur. So it tends to be maybe just the entrepreneur plus somebody, or maybe just the entrepreneur, and then maybe they contract out some of the help to other people. But the business is worth nothing today. It could be worth, based on the math that's been presented here, assuming everything was working, it could be worth about $22,000. And so let's get in and figure out why that is. Two things to know about your business. You have a balance sheet, you have a profit and loss statement. Your balance sheet tells you what your business owns and what it owes. And the difference between those two numbers is called equity, much like your personal net worth statement. You take all your assets, your house, your car, your furniture, all that stuff, you subtract out your Visa card, your mortgages, your car loans, and whatever's left is kind of your personal net worth. Well, it works the same way for a business. You have assets in your business, you have loans and liabilities, and then if you subtract those two, what you end up getting is the equity that's remaining. On the other statement that you have is called a profit and loss statement, a P&L. It's kind of the shorthand for it. You'd think that BS would be like short term for balance sheet, but no one really talks like that. So your P&L, your profit and loss, your revenue, your expenses, basically, here's what your business earns, here's what your business spends, and then here's what's left. And the question that many entrepreneurs never ask themselves is, what am I doing with what's left? The answer is, if we look at your balance sheet, we can see what you're doing, because the cash in the business either leaves and it goes out to the owners, or it goes out to other people, or it stays inside of the business and is used to pay down debt or purchase assets or do something that will hopefully help the business generate more revenue. So these two statements work really well together, and you don't have to be an accountant or a financial whiz to know this. You just need to know that your balance sheet is what your business owns and owes. And where does it get the money to own or owe anything? Well, from your profit and loss statement, which shows you how much your business earns, how much it spends, and then what's left over. And what's left over hopefully finds its way back to the balance sheet in terms of buying assets or paying off liabilities. So in this particular case, this business has about $50,000 worth of assets, got about $23,000 worth of liabilities, which means they've built up about $26,000 worth of equity over the years. So that's pretty good. That means that at some point, the business was either really profitable, or over time has just been profitable consistently, that they've been able to build up some equity in the business. But if we go and take a look at the P&L for the last 12 months, what we can see here, make sure this is 12 months. Yeah, 12 months. The business generated about $50,000 worth of revenue. It have spent about $43,000 to earn that revenue. So that's pretty much consistent with what I said earlier. They probably have like hired help or subcontractors that they're using to help their business, which means after they've paid for all of that, they've got about $7,300 left to spend on the business. Now, they're showing about $16,000 worth of expenses, which means they're losing $8,700. But if I go to the balance sheet and I can see that the equity is positive, what that tells me is that maybe they're just having a bad year. And that wouldn't surprise anybody, I don't think, because I think many businesses have had a tough year with COVID and the likes. So they've spent more here, and you can see the expenses at $16,000 is significantly more than the $7,300 that the business generated from its sales activities. And so they're running a loss. So what that means is if we were to maybe look at this balance sheet in 6 months from now, we would see that equity is probably going to keep dropping unless this entrepreneur can turn their business around. So let's talk about that a little bit. The reason this business is worth, if we go back up here, the reason the business is only worth about 22, 23, just call it $25,000, is because there's really not a lot here. The business can generate some revenue. It has built up some profit over time, but I'm guessing it's highly, 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 highly dependent upon the entrepreneur showing up for work every day and doing a job. And so probably, if I was looking at this business and trying to figure out how to make it maybe a $100,000 business, I would say to the entrepreneur, first of all, is this a side hustle? Is it a part-time gig? Is it a part-time job? Is it kind of a hobby? Because if it is, then either you need to find someone else to do what you're doing and then give them, all the money that gets made until such time as their salary's been covered. And then, hopefully they do more than that, and, you can take a little profit off of them. But if this is something that maybe you think only you can do, then you've really got to get that revenue up. And if you're trading, small businesses like this, the entrepreneur tends to just trade their time for money. And an entrepreneur can oftentimes say, I've got one or two really good clients, or I have a handful of good clients. So the question would be, well, how can you get another handful? How can you take your revenue from 50,000 all the way up to, let's say, 150,000 or maybe 125,000, just to be able to cover your expenses and then to pay the people that are helping you earn that revenue? So how can you do that? Or do you have some expenses maybe that you're paying for that you don't need to pay for? In a small business like that, sometimes that can look like maybe you're paying a social media person, but you're not getting the results that you want from that social media person. So because you got to pay them, it's showing up in your expenses, but you're not generating enough revenue to maybe cover those expenses. So you could try to do some of that stuff on your own. Maybe take more of like a guerrilla social marketing approach. Social marketing is something that you just have to be doing on a consistent basis. So maybe you could start making your own posts or your own videos or something like that instead of hiring it out. Maybe you have an SEO person who's buying some keyword ads for you on Google. I don't know, but somehow you got to bring those expenses in line. And if those expenses are you, maybe in this particular case, the entrepreneur is just taking more money out of the business than what it's able to take out because of the net profit here is showing that there's a loss, then maybe the entrepreneur has to, figure out, how do I not take more out of this business? And the answer is always sales cures all. So this particular business owner, it looks like they probably have like a decent little business here. At $25,000, that's what it would be worth if it could kind of straighten itself out a little bit. Because I know how the math is generated, I would say that they got to trim they got to trim their expenses, or maybe just take a look at their cost of goods. Do they really need to be contracting out every job task to someone else and paying for it? Or is there something else that if the business owner can't generate an enormous amount of revenue, could they maybe take on some more of the work so that they can pay themselves that money instead of paying somebody else and running a loss? Let me just see what else stands out for me here as I look at this business. I guess if you're an entrepreneur, you probably would want to sit back and go like, what's my goal for this business? Is my goal just to, like, this is right now as presented, this is a bit of a headache. This is like a make work project. A little bit of equity in the business. Business is currently running a loss, probably going to continue to run a loss unless the entrepreneur makes some different decisions. And so as the entrepreneur, you go, why do we even have this business? What do I see in it? And that's probably the best place to start. Today your business is worth $23,000 to $25,000. I don't know whether someone would pay that, but based on the math, again, just using it as a benchmark and as a milestone that should encourage you to figure out how to make your business better. That's kind of what you have to work with. And so, what else would I say here? Yeah, figure out. The entrepreneur would probably figure out, what do you want to do with this business? Is it reasonable you could get to, could you double your revenue? Could you go from 50 to 100? Could you go from 50 to 150? Because at that point, it's probably a very meaningful business. It'll probably generate, if you can bring your costs back in line, it's probably going to, produce a nice little paycheck for you. And if you've got a regular job and this is just your side project, then, that's some vacation money and maybe even keeps you occupied during COVID or keeps you busy, as it were. And then, on the other side, I'm just looking at the liabilities here. Maybe you say to yourself, look, if I didn't have the liabilities, I'd probably have better cash flow because of interest and so forth. So my goal is going to be, I'm going to generate the amount of revenue that I need and kind of bring my costs in line so I can get my liabilities down. And then maybe someone buys this business for the assets as opposed to the cash flow, because there is about $50,000 worth of assets on the balance sheet, even though there's $23,000 worth of liability. So that could be a goal as well. So those are my thoughts. Looking at this particular individual's business valuation, lots of things to jump out there, and I inevitably will be chatting with this individual offline to go through some of these results. But I thought on on an anonymous basis that I could, record this, put it out on a podcast, put it out on a video, and hopefully it gets in front of some other entrepreneurs that could maybe find some of this pretty interesting. So anyway, that's it for episode number 1. That's very, very exciting. And I would encourage you to keep, to follow, to do what you need to do, because I'm going to do these on a very regular and more frequent basis. So anyway, thanks for tuning in.